Hello, everybody. This week, market focus really all turns against the FOMC meeting on Wednesday, where the Federal Reserve will announce its rate decision. Even though a lot of attention will be on the FOMC meeting, obviously, there's a lot of consensus about what the outcome will be. Really unchanged compared to the latest FOMC meeting. No new signals from the FOMC, no rate hike, no change in monetary parameters in general. And frankly speaking, that's also our view of things. However, I do want to give you all an update on how our monetary policy analysis framework looks at the moment, what we're looking at, and what our indicators are telling us about the outlook for US inflation and monetary policy in general in the US. Overall, when we assess monetary policy in the US, we use four sets of indicators and parameters. First of all, we look at our monetary indicator, which is an indicator for medium-term inflation outlook. It doesn't tell us much about the near term, but it tells us something about how overall monetary policy is calibrated relative to hitting the FOMC's or the Fed's 2% inflation target. Secondly, we look at different monetary policy rates, essentially trying to assess if you follow rules like the Taylor rule or nominal GDP rule or price level target rule, how would the Federal Reserve then move rates going forward? Thirdly, we look at what we call our forward guidance indicator, which is essentially a quantitative analysis of the rhetoric of the Federal Reserve. What is the FOMC saying about the future outlook, and what is that telling us about the rate outlook going forward? And fourthly, we're looking at what we call our monetary shock indicator, which tracks developments in the money supply and in the money base relative to expectations to assess whether there has been any shocks to monetary conditions. If you look at those four sets of indicators right now, the first thing we conclude is that our monetary indicator is more or less on track, meaning that it is close to zero. The indicator has been calibrated such that if it's zero, it would mean that the Fed would hit its 2% inflation target over the medium term. Presently, it's slightly above zero, indicating that the risk is for the Fed to slightly overshoot its inflation target in the medium term. However, it's not by a lot. In fact, our inflation forecast in the next 2-3 years ahead is for the Fed for inflation to converge around 2.1%, very much in line with what the FOMC and the Federal Reserve in general expect, and also is, I think, the perception and the expectation of most analysts. So no big deal there. Monetary policy is in general calibrated pretty well in the US, and the Fed is pretty much on track to deliver on its target. If we, on the other hand, look at different policy rules for interest rates, which I think is something is very useful in assessing how rates will be moving going forward, and something that the Fed Chief Powell has highlighted that he's actually looking at, then we can see that overall the toolbox of policy rules that we're looking at, including a Taylor rule, including a nominal GDP rule, indicates that given reasonable assumptions for economic activity and inflation, we will see more rate hike going forward from the Federal Reserve, and the simulations we have done very much indicates that the markets have got it more or less right. We're looking at 2-3 25 basis points rate hikes over the next 12 to 24 months. However, more importantly, over the next 24 months, we do not expect the Fed to hike rates above 3%. We believe rates will in fact peak below 3%. And more importantly, contrary to what the FOMC indicated at the latest FOMC meeting, rates on a 3 to 4 year horizon will not move above 3%. Rather, the Fed funds target is likely to peak at less than 3% and actually decline slightly from that peak level on a 3 to 4 year horizon, simply from the fact that we end up at the point now where unemployment is below the natural rate, and if unemployment moves above or back to the natural level, we should see unemployment going up relative to present levels on a 3 to 4 year horizons, which would cause rates to move down from the peaks in 1 or 2 years. And that's where really our disagreement with FOMC forecast comes up. Because if you look at it, yes, on a 12 to 24 month horizon, the market and the FOMC is more or less in agreement, moderate rate hikes going forward. But on a 3 to 4 year horizon, the FOMC is a lot more hawkish than both we and the market are. And one thing we have stressed is that if the FOMC actually in, let's say, 2019, late 2019 or during 2020, move rates above 3%, as is essentially forecasted right now by the FOMC, then it would mean that the yield curve would invert, and that would most definitely lead to a recession either in 2020 or in 2021. And that would then force the FOMC to cut rates more or less aggressively and even move rates back to the zero lower bound in 2021, which in itself is a reason not to expect rates to move above 3%. So yes, fairly undramatic outlook for the next 12 months in our view. 24 months becomes more challenging. 36 months, clearly no more rate hikes. But that wouldn't surprise the market. It would surprise the hawks on the FOMC. If you look at, however, what the Fed is communicating, if you look at our forward guidance indicator, which is essentially counting hawkish and dovish terms in each FOMC statement, then the outlook isn't as hawkish as one could be led to conclude from just looking at the so-called Fed dots. The latest statement is indicating more rate hikes, but not much more so than what is indicating by looking at policy rules, 2 or 3 rate hikes over the next 12 months. And if you look at the underlying macro fundamentals determining the rhetoric, we are pretty much where we are supposed to be and expected to be. And we also, if you look at that in terms of what will the statement look like on Wednesday, we see a statement from the FOMC very, very similar to the latest FOMC statement. So we don't expect any surprise on that. So in terms of forward guidance, no major surprises expected. Finally, if we look at money base and money supply growth, it's pretty much aligned with what is expected. So our monetary shock indicator is still in a neutral level. However, I would stress that if we were to see the Fed move the short-term rate above 3%, policy rate above 3% in, let's say, 24 or 36 months, then that likely would cause a monetary shock. And the reason we like to look at this is not for the very near term, but as the Fed has become more hawkish in its rhetoric, it's also interesting to see when is the Fed overdoing it relative to market expectations, and our monetary shock indicator will capture that if that were to happen. So overall, the picture is that we're not looking at any major surprise tomorrow. In fact, the Fed at the moment seems to be pretty much on track. Inflation expectations is pretty much on track. Things are looking pretty benign. However, the challenges becomes when we move further ahead. If we are beginning to see any softening of the US economy, will the Fed then insist on being hawkish? And we're a little bit fearful about that. But there is no indications in the very near term, over the next 12 months at least, that the Fed is going to make any major negative policy surprises. But we will keep an eye on that. And we believe the framework that I've just presented gives us a very good set of tools by which to track the FOMC and what the Fed is doing with monetary policy. If you want to hear more about our framework, you're very welcome to contact us. Drop me a mail, and we will be happy to talk to present and future clients about our framework. Thank you very much, and enjoy your May 1st.